Welcome to LiquidityWiz, where we will teach you how to read liquidity flows in the global economy and turn you into a wizard. Our aim in this introductory video is to provide you with a general understanding of the liquidity concept, show you how we analyze liquidity data, and explore why it could potentially be the most significant contribution to your investment strategies and trading practices. Liquidity is a very comprehensive term. We may find ourselves dealing with different underlying concepts. One of the most common interpretations of liquidity is market liquidity, which refers to the depth of order books that allow trading volumes to be executed easily and finalize trades in a desirable manner, from a price perspective, while minimizing volatility. However, liquidity can also be understood as the amount of capital that flows through the financial system, allowing it to function and remain vital by collateralizing and financing public and private debts. Liquidity can refer to the money in your checking account or the money-like assets that cover your debts and the debts themselves, as well as the capital injected by banks into the economy through the banking system during times of crisis. In other words, liquidity refers to money, and the type of liquidity that we at LiquidityWiz are focusing on is the liquid money available in the economy, which not only facilitates trading, but can also impact the global economy by driving waves of market trends, influencing the value of all financial assets, and preventing insolvency crises. In our dashboard, we look at the global supply of liquid money in cycles, as aggregates, and by each country in the world. We look at the net circulating liquidity resulting from the monetary policies of the most important economies in the world, like the United States and China. We look at central banks' liquidity injections, balance sheet size, and assets purchases. We look at credit, crypto, and much more. We tackle liquidity from each possible side. We believe it's important to understand that, through the process of money creation, the injection of new liquidity into the system or its withdrawal impacts the markets in their function to price perceived value. It is natural to understand that if money is the unit of account of value, a bigger supply or, in other words, more liquidity causes the same amount of value to be repriced with more of those units of account. But why would this be the case? Why is there even a need for more liquidity? Obviously, because liquidity can be very conveniently used to stimulate a stagnant economy. As we'll explore more in depth when we will talk about money creation in a dedicated video, new debt or new credit adds more liquidity to the system, but in a sense, that's also adding more leverage to it. One of the natural properties of leverage is to get washed out at some point, usually during a crisis of some sort. But when mostly politics can't allow a proper liquidation cascade to take place and rents the excess leverage for the markets, they get flooded with liquidity. The bigger the debt burden, the bigger the liquidity injection to bail out whatever corner of the financial system may be in need of intervention. The bigger the stimulus to the economy, the stronger the inflationary pressure against the prices of valuable assets. These are the times we live through, and therefore we believe these metrics are very important now, and will become even more important in the near future, or at least until the debt economy works in this intended way. So, subscribe now to the channel and follow us on our social media to get our content delivered to your feed. Sign up on LiquidityWiz.com and become a wizard.